You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Session here. We got a couple minutes to introduce the founders of Swan Global Investments, Randy and Rob Swan here. After that, we'll conclude and have some cocktails, and then everyone has some evening plans as well. This is meant to be a very loose and formal session, kind of give an idea of the whole history of Swan and why we are where we are today. So, Randy, let's start at the beginning here. You started the defined risk strategy over 20 years ago, kind of in the midst of this period that we were talking about with Greenspan and rational exuberance and all that. What was the genesis of your idea, and what were your goals then when you initially started this strategy?
Sure. The short answer is I think there's a fundamental problem in modern portfolio theory, and that is you can't manage market risk directly. Diversification is not the entire solution. It's definitely part of the solution. And so creating a strategy that really can fix some of those problems with modern portfolio theory was really my central thesis. Now, it's also true that I did it in the backdrop of irrational exuberance. And so when I fundamentally go back to, and I think Danielle said it earlier, she said this is not a 10 or 15-year problem that we've had. This is more of a 30-year problem. And you go back and graph the PE ratio of the S&P 500 going back 120 years, every year since 1988 has been in the upper quadrant of valuation. So this is more of a systemic long-term problem that we've been building over time. And so getting back to the concept of, when I designed the strategy, it's really what do you do in a market environment that you think is forming a bubble? And one way obviously is to think that you can time the market or be tactical in that sense. Another way is to try to design a strategy that you think over the long haul will actually provide value to the clients and really take away that necessity, quite frankly, to be able to predict the market. And so that's from the biggest framework of why I did it. The goal obviously is to give the clients a better experience. We offer that through protection, smoother returns, but our stated goal is really to outperform the market over a full market cycle. Now, maybe the more controversial answer to that is that why do the central banks do what they do? And I go back to is because the political process has somewhat failed. In the age of snowflakes and participation trophies, fundamentally, we're a society that no longer tolerates any pain or anyone failing. And so this has been going on now for decades, and eventually will end probably in a bad way. I'm not sure when or how it's going to play out, but I think that's fundamental to why the strategy was designed, is really to be able to give you the flexibility to be able to invest for the long haul in equities that give you, we think, the best returns, but also take into account of what's probably going to happen. And so this has been a fun process, obviously, with the low yield, low interest rate environment we're in right now. I think it's even more compelling to kind of shift away from fixed income and into equity, but obviously we would argue for hedged equity.
Okay. And you had the advantage of being an investor from an early start. You had some experience trying all the standard investment solutions before you kind of struck upon this concept. Can you shed a little bit of light on that too?
Sure. I was an investor during the 87 crash and the 90-91 recession, and many of those tried and true ways to build portfolios and try to generate returns, it's pretty frustrating to go through and lose money. And that's obviously the biggest thing for clients at the end of the day is, can they stomach? People always tell you in a vacuum, oh, I understand risk. I know I need to take some risk to get the returns I want, and I'm long-term. I've yet to see that to be true with clients. Just my experience is they always say that, but at the end of the day, it's what have you done for me lately? And so really my process was just allowing to get into a strategy that you can really stay the course and benefit from the long-term performance of stocks.
Having experienced the 87 crash and the 91 recession and the market losses there, I was going to make a crack about you being 65 years old, but the truth is that you were actually investing as a teenager, right?
That's correct. The 87 crash was when I was in college, but yes, I started investing about 14 years old. And it's been a long experience, but it's been good because I always tell people that I had kind of gone through a lot of the pitfalls of investing really before I had graduated high school and college. So started out early.
Okay. So Swan was originally a wealth management shop, and one of your first clients was Rob over here. Now, of course, Rob is your brother, one of the few people who have been an investor in the strategy from the very outset. So I guess the question is, Rob, why would you trust Randy with your money?
Well, so I would probably say I might have been one of the first investors in the strategy, but I'll go back to when Randy was 14. I was already investing in Randy's success, with Randy lending me money at really high rates when I was. So, but ultimately, Randy's always been infatuated with the investment markets. I know he went in and became an accountant, worked for KPMG, but I think his love was always in the financial markets. One of his Christmas presents from my parents was a safe where he used to keep his gold bars and his stock certificates. You know, this is like 12, 13 years old, from the proceeds of his lawn care business. So it was, I knew that wasn't my area. My area was aerodynamics engineering. I like to solve problems. I like to take things apart and put them back together. You know,
including Randy Safe?
Including, well, right. I do have a ridiculous story of one time when I was trying to siphon gas from my dad's car with a vacuum cleaner. And that wasn't one of my highlights, but I know when it blew up, and I'm running around trying to concoct my story on why the car spontaneously combusted in the driveway. Randy was playing football with his friends, and I think one of his friends said, "Hey, Randy, your brother's on fire." And he always does that. But in any event, I think that Randy's always been very focused on basically growing his assets and basically loves this particular area. He went through and tried everything under the sun. I think that his experience with KPMG and working with offshore insurance companies put him in a position to say, you should be able to do something similar to the way that insurance companies are managing their book by hedging the downside. And I think that that's where it came from. And we talked a lot as, when as an aerodynamics engineer, Randy's launching the strategy, he would run things by me basically in terms of the strategy, the option strategy. As an engineer, I understood what he was doing. But honestly, I knew that I was investing alongside Randy, and he wasn't going to lose his own money or our parents' money. So to me, that's all the confidence I needed.
Okay, great. Well, let's talk then about the first challenge that the DRS faced, because the inception of this strategy was July of 1997. So roll the clock forward, maybe just over a year. What do we have? We've got the Russian default. We've got long-term credit melting down. Now, during that period, in August 1998, the S&P 500 lost about 15% over 2 months. And during that stretch, the DRS actually performed worse. It was down about 18.5. So describe what was going on as far as the market was concerned, and then mentally, emotionally, like did you have any kind of doubts during this stretch, during those trying times? What was that like when you had just started this?
Sure. Do you mind putting up the target return band?
Sure.
Just by itself?
Yeah.
Well, 1998 was about a year into the strategy. I was obviously very focused on really wanting the market to sell off. Of course, when you're selling options as well as long volatility, you kind of want it to happen in your exact time frame, and that's obviously impossible to really do. But fundamentally, I go back to the target return band, and this kind of graphically shows what we expect to do on an annual basis. And so, I would say is that as long as we're in that target return band, we're performing as expected. Now, the two variations that we deal with even today, after doing this for over 20 years, is really, what happens in the short term, and do those expectations match up with the target return band? And so there's really two things that really kind of get in the way of a 1998 situation. And most people remember the market had gone up a lot, sold off into the summer due to long-term capital management, and then rallied into the year like nothing had ever happened, right? That was the kind of framework we're in. But the two things that people need to realize is when we tell those people in our strategy is, this is on average a yearly strategy in terms of we're going to hedge at the beginning of the year, and we're going to hold that hedge to the end of the year, and then we're going to adjust the strike price on the options basically up or down depending on what the market did. So one of the first concepts that we deal with educating our clients is really the intra-year gains. What do you do with the intra-year gains? Because people sometimes think, hey, If I came in and 3 months later the market's down, should I get the very low downside capture? And so one of the things that we tell people is that by and large the inter-year gains are not locked in until the end of the year. And so that's one of the things how we can be down, quote, greater than the market in a short period of time. The second one is the option income component, right? Chris Hausman talked a lot today about how we sell the short-dated options to try to generate income, and that allows us to potentially have less downside in bear markets, pay for the hedge in flat markets, and maybe a higher upside in up years. And so the problem with that is obviously when you're selling short-term options, you can have more volatile expectations or fluctuations in the income or losses in those types of strategies. So that's one of the things that, everything else being equal, adds to that loss in the short term. It just sometimes makes investors question on whether or not the protection is really in place. Going back to this graph over here, though, if we graph that on a monthly basis and where we're at, we should really be on that gold line or higher all during the year, plus or minus what the income trades do. So you do have some short-term fluctuations on the income trades. It is a necessary evil to have to give you the long-term, smooth, consistent returns that we show in our spaghetti rope chart.
Okay, great. Now, to this day, that does remain the biggest drawdown in the DRS's history, is right out of the gates there within the first, call it, 15 months of the program. Now, you had designed this thing, you had built this thing, but let's put the shoe on the other foot. Rob was the investor. What were you feeling through all this? Did you have any second thoughts, regrets? Tell us about that.
No, I really didn't. I mean, I enjoyed talking to Randy about the construction of the strategy. I know that Randy wrote a book on the strategy at one point, and so I was kind of proofreading the book, and I think he was going to sell the book, try to sell the kind of the brochure on how to run this strategy, and luckily he never sold any copies. So we ended up having a strategy today that really was born out of him trying to find a better way to invest for his own money, for our family's money. And so I didn't have, I was probably a perfect investor. Randy would call me during some of these times and, have you seen what the market's doing? And I was like, why would I watch the market? It's like, I've got my money with you. You're not going to lose it. So I was perfect like that. I was off, I don't know, sailing my boat or something like that while Randy was worrying about it or being excited by it. He was more worried when the markets were going up, and then basically never having the full market cycle, some of these times, between 2002 or 3 to 2008, that time frame, or leading into the tech bubble. But no, I didn't. I had no doubts that he would not lose his own money.
Okay, great. So yes, you kind of mentioned the LTCM thing did resolve itself rather quickly, and then we were back right into that irrational exuberance stage. And we had the dot-com bubble all the way through the first quarter of 2000. It wasn't until 2 years later that things really burst. We had our true bear market there, the first one since since '87. So let's think about what happened there. During that stretch, it was 3 years where the markets were pretty much down, 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 down. Very drawn out, very painful, about 45% from peak to trough there. Now, what was going on during that time? Well, we always had the dot-com bubble bursting, but we also had the September 11th attacks. We had Enron failing, Arthur Andersen, lots of other accounting scandals, everything leading to the Sarbanes-Oxley Act. Now, during this stretch, the DRS actually did quite well. It was up over 20% and did perform as intended. So, big, long, drawn-out bear market. Randy, when did you know that this was what you've been waiting for? This is it.
Well, sure. As I said earlier, the full market cycle is what this strategy is built on. If we never have a bear market, the strategy is not a suitable investment for probably anyone at that point. But knowing that cycles do occur and nothing's new under the sun, and that means that we are going to go through cycles, however extended they get sometime. But no, I think the first bear market in the strategy was obviously 2000 to 2002. And that's something that actually kind of was the first kind of proof that this strategy actually could work. And I think starting out during the dot-com bubble is actually perfect for us. But it always kind of goes back to the targeted return band and how you expect relative to what you did. Now, sometimes people ask me, how can you actually money? There's one thing about being somewhat protected and versus actually making money in some of these down years. Well, one of the main components of the strategy is really actually the kind of intra-year rehedge process. And what that really means is that when we start from that 90-10 split between equity and options, when that gets out of whack, let's just say 70-30, you're going to want to kind of rebalance that. And what that means is selling deep in the money put options for a profit, buying a similar put option at a lower strike price and using that excess cash to buy more shares. And so that's really kind of the way this strategy really works and benefits from the bear market. And so I think that was just kind of going through the proof concept. And obviously I felt very good about the performance during the bear market and was really off to the races at that point in terms of wanting more. But I think it was a good experience because it always does take experience to go through things like this to kind of learn and see what works and what doesn't. But for the most part, I'd say it worked very well.
Okay. Now, this one has to be directed towards Rob because during Thanksgiving dinner 2000, 2001, 2002, were there lots of I told you so, this was going to work?
You know what? I'm not sure that I remember that far back, but I do know that I gained more and more confidence in the strategy. I was never worried about the downside. I think that a lot of people probably thought, well, okay, you got lucky 2000 to 2002, so can you do it again? So Randy really didn't decide to kind of roll this out beyond kind of the friends and family until quite a bit later, proving it again in 2008 and 9. And I think that it was really that time that it kind of proved, not just luck, but by design, the strategy was going to deliver a proven way to deliver really consistent returns and that protection. And I think that that's when really decided to start partnering, expanding out. That's when I joined the firm and starting to expand out and offer the strategy out there to investment advisors.
Okay. Yeah, let's talk about the global financial crisis. And it's been over 10 years, of course, but try to put yourself back in the seat there when it seemed like the entire world was falling apart. And we had Bear Stearns being sold off for $2 a share, JP Morgan, you had Lehman Brothers on full-on collapse, Merrill Lynch shotgun wedding over with Bank of America, Wachovia, Washington Mutual, Fannie and Freddie being put into receivership, AIG, General Motors having to be bailed out, Citigroup having all their equity evaporating. I mean, it was a very trying time for anyone. And at one point, autumn of 2008, the strategy was down 13.6%. Now, of course, the market was down more, but unlike 1998, the market went into free fall. By this time, you had more investors in the strategy. What was their response to this environment? Because obviously they didn't know you. They didn't know you like your brother. I mean, they're seeing the reading the headlines, watching everything fall apart. What was it like for someone who just put their money in you in the last couple of years?
Well, actually, I have a really good example of an investor that sold his business in August of 2008 and invested his entire proceeds with our firm. And I remember kind of going through the educational process and kind of explaining how the target return band and what kind of risk exposure he had. And I think it was overall a generally positive experience. Now, not to say that he didn't call me up a couple times and say, hey, I think I'm down more than 7% or something like that. But at the end of the day, I think he ended up down 1% in 2008, which is obviously very good relative to what the market had. But I think it came back. What I took out of that was really it comes down to education. So, as we've grown as a firm, as we've built out our product mix, it really comes down to educating the advisors that we work with, the partners we work with, so that we can work together to educate the individual investors and the clients of the advisors. Because, if that is missing, it becomes very difficult for people to weather those type of market environments because they expect, hey, if the market's down 15%, I should only be down 5.2, or something like that. And that's where the education gets back into. I know that's one of the big things Mark is involved in, is really trying to help that education. So I think it all goes back to we were performing as expected, trying to minimize that gap between what the expectations from our perspective and what the expectations of the clients is really what it came down to. Now, from a trading perspective, I think that was just a ridiculous time period of having to make a lot of adjustment on our income trades. And I remember the rehedge on October 8th of 2008. And at that time, I think the market had dropped from 1450 down to 1,000. We rehedged the portfolio, got, I think it was like 35, 40% more shares for our clients. That was a great experience. And then literally within a week, I think the market had dropped another 15%. So it was a crazy time period. But when the smoke cleared at the end of the year, I think we were down 4.5%, and we got a lot of extra shares for our clients. So I knew I was set up very well. And I think, from my perspective, not to make a market call, because our strategy is really designed to try to get one, but we would prefer two rehedge opportunities. And we did the similar type rehedge in March of 2009. And that time, that was obviously very close to the low in the market. So it was really, it was an exceptionally crazy time, obviously, most of you guys remember. But from the trading perspective, it was just, it was amazing to see how much fluctuation and how much movement in the markets were going on.
Wow.
Hey, before you go on, I mean, I want to just add to that one client that Randy's talking about. Years later, this client, even though taking him through some significant protection, all of his friends probably said, "Man, you're crazy giving all your money proceeds from your sale of your business to a guy." This guy found Randy in the Yellow Pages in Durango. It was the only client Randy ever got from the Yellow Pages. But it's worked out really well for him. But years later, he comes up to us, walks into the office, and basically says, this was right before the election, and says, "Well, I just got a feeling, Rob, I think that I'd like to sell everything and go to cash." And
in 16, the election
this in 16, yes. And we're saying, I'm saying, "Dennis, this, we've already taken you through this protection. You know how this works. Why would you do that?" "Well, I'm just kind of an all or nothing type of guy, and I just got a feeling. I think that if Donald Trump wins, the market's going to crash, and if Hillary Clinton wins, then the market's going to crash, And so I want to go to cash." And his accountant's probably freaking out because of all the low, he was going to be paying a lot of taxes, if he liquidated everything, given the fact that he came in 2008. So we basically convinced him, well, let's hold off. If you honestly believe that, then what we're going to do is we're going to put in some extra protection, and it kind of goes to the flexibility of our overlay program. So we just put in some extra short-term hedges for him, kind of truncated his upside when he was wrong, and for a little while, overnight, we thought, hey, he was going to be the hero, right, but in buying these extra hedges, or us buying them for him. But then it turns around, and he basically ended up giving up probably half of that immediate upside that he had, but he still had upside, and he didn't pay all the taxes. And he came in a couple weeks later, and he had his head down, and he said, "Well, Rob, if you ever need somebody with a keen sense of market timing, I'm your guy." And he says, "Well, don't listen to me anymore. You just do what you're going to do with your strategy." So it just kind of goes to show, even if you provide that protection, people have short-term memories, and their emotion can get hold of them. So constantly reminding them why they're in this and what how this strategy works, and trying to provide that feedback is super important, even if you are protecting them multiple times.
Okay, great. Now, Rob, you officially joined the company back when it was 2009, correct?
Yes.
Yeah. So what was the first thing that you did there when you got to contribute?
I think that Randy, we had been talking about me joining for quite a while. Like I said, I was very familiar with the strategy, one of the early investors. I think that when I came down, I think Randy's goal for me was to, take on some of the trading and investment management, take that off of his plate. He'd probably been captive to the markets for, since he started back in 1997. So I don't think he really went on vacations without his computer in terms of trading every single market day. So I did come in and learn that. My background is aerodynamics engineering. It's not the financial markets. I came in, I did learn that aspect of the market very quickly. But what I found out is when I'm trying to manage all of these accounts, we had started to bring on a couple relationships with some advisors. We didn't have any funds. We basically had separately managed accounts. And so when you're trying to manage a strategy that is actively managed, sophisticated, options-based, there's no off-the-shelf software. This kind of baskets of stocks doesn't really apply. And so I'm trying to figure out how to manage a couple advisors, two advisors that we had. And it was maybe 50 accounts or something like that. So not too many accounts, but managing that in a spreadsheet was absolutely ridiculous. And there was no way that was going to be scalable. And so I think that what I found very quickly for my own purposes, that I needed to use what I had been doing, aerodynamics engineering, and then software development, to really focus on technology. There was nothing that I could buy off the shelf. So I'm not a coder, but I know what I needed to be able to do. And so we built our own internal proprietary system that allowed us to trade all accounts in block trades, and it would recognize when monies would come in or monies would go out. I didn't even have to know about it. We could do buy-ins and liquidations and fee and billing and adjustments of income trades and re-hedges, and it was really taking 50 accounts or 100 accounts and being able to block them into aggregate groups of, hey, we need to buy up in the strategy, or we need to liquidate a little bit to keep everybody within compliance, to be able to move all of those accounts at once within minutes as if there was just one account. And that process was not done with any serious forethought to how important that was going to be, but it was more just I needed to be able to do this in order to be able to execute those trades without dumbing down the strategy. And I think it's super important to realize that if you've got a manager who is actively managed and offering a sophisticated strategy, if operationally they can't do what they want to do, they only have the choice of saying, you know what, it's easier to trade once every quarter, because it's one trade or whatever. And we don't do that. We trade when we need to, how we need to. We trade thousands of accounts in this system. And even though now we have funds, which that's one account, but the fund is just traded alongside all the separately managed accounts. So we tackle that kind of scalability issue, and I think that's probably been my biggest contribution, to the firm is kind of really pushing forward on technology to allow us to scale up.
Okay. Now, speaking of which, you talk about like some of the competitors out there, and one of the things that was mentioned previously is just how quickly the options-based space has been growing, how many new competitors there are there. You go back in the databases, there's not a whole lot of people who have been doing this for 20 plus years though. So what have you noticed, Randy, change in the options marketplace over the last 20 years?
Well, I guess there's three main things. I would say, obviously, there's a lot more investment products. I mean, everyone remembers the original ETF, that was SPY, that was launched, I think, in 1993. So now, as we mentioned earlier, we're really agnostic as to the underlying portfolio. So with all the ETF boom, we really embrace that, and we really like that aspect. Now, of course, we think our strategy is kind of a value add, and it kind of goes to the customization of the option overlay. We can take any existing portfolio. So I think having those different products, like a GLD or something like that you can actually do the strategy on has been great for us. I think the spreads, as Chris Hausman mentioned earlier, has come down a lot. I actually remember paying at Schwab $14 a contract for an SPX trade. Obviously now we're paying about $1. So things have definitely come down in terms of cost and ability to be able to trade these type of strategies. So I think it's been overall good. I don't really get into the concept of, is something changed permanently at this point, or are we going through some cycle back and forth? I mean, as I said earlier, I don't think there's nothing really new under the sun. I think we go through ebbs and flows of the market. And really, the design of the strategy, the goal is to design something that's going to work over the very long term. I know that I mentioned earlier, clients really don't, they say long term, but they're really not long term. But to design something that you want to win, you got to be able to win in a long haul. And that means not trying to predict and let's decide when we're going to hedge, not to hedge. Pick a hedging mechanism, long-dated options that we think is going to provide with the lowest cost. Can you really generate a strategy that is going to be able to, quote, pay for itself over a full market cycle like we think we have at Swan? So those are the kind of things that have changed to benefit our strategy and benefit our clients at the end of the day, to give them more products.
Okay. Well, let's expand that conversation. Talk about we were originally talking specifically about the options world in the last 20 years. From the investor standpoint, from the broad macroeconomic standpoint, what do you think's changed for the investors the last 20 years?
Well, definitely besides the increase in products that we already talked about, I think the biggest negative, obviously, is the interest rate environment, right? So despite my concept of modern portfolio theory has some limitations, when you can make 6% on your bond portfolio, that's going to go a long way to provide consistent returns and stability to your portfolio. You take that away and you're left with a 2 to 3% yield, it's really forcing you have less options, right? And so you're going to go in typically to more risky investments. So I think that's the biggest kind of negative. I kind of go back to I think the previous panelist asked, what inning are we in? I kind of go back to, I think David Shepard came down to my house in Puerto Rico a couple years ago, and we were talking about, he goes, what do you think about Puerto Rico? I said, well, they're closer to the truth. And I said, they're going through a lot of economic problems. I think this is what's going to happen around the globe. And Puerto Rico is a small island of 3.5, 4 million people. They're paying the price for the decisions they've made in terms of the debt they've accumulated. And it's just something that I think is really, at some point, going to hit everyone hard. And I don't think there's any way out of it, right? And I think this goes back to the smartest guys in the smartest rooms have decided that they're going to play this game and try to defer these problems out indefinitely. And I think I use the analogy of kind of a forest fire. If you don't allow forest fires, when you have one, it's going to be bigger. And so I think that's kind of, apropos at this point is, we just don't know when that's going to happen, how it's actually going to play out. But it goes back to, is this a problem that the traditional way of managing money, is it going to solve that problem if you think that's a legitimate problem? Of course, we do at Swan. It was really kind of one of the bases of why we did the strategy in the first place. But it kind of goes back to can you use more modern tools in the war against losses, volatility, sequencing risk, aging population, baby boomers trying to live off whatever assets they have. We think that obviously options are the new weapon of war, and they're something that can give you a better experience to get to the end.
Okay. I definitely want to leave some time at the end for audience questions, but I got one or two more here. I guess this question is for both of you. You answer it in turn. What's been the most challenging aspect of running this strategy?
Well, I think you have three components to the strategy for me. I mean, in terms of running a business, one is designing and implementing and running the best strategy you can actually do. The second thing is doing it in the constraints of a business that you're obviously trying to make money with employees and long-term costs and constricting fee schedules and all those things like that. And then also, I think the third one is really the client expectations. We talked about that's a big part of what we try to do at Swan is try to educate and really prepare clients for what's realistic and not. And so doing all those three things at the same time, my Algebra 2 has lost me. I'm not sure exactly how you do that anymore, but yeah, you're solving three problems at the same time for three variables.
So I would probably reiterate the client expectations. Sometimes it's very frustrating from our point of view. We may think that we've done really good in managing, let's say 2018, for example. I mean, losing 2% in income component in a 2018 environment is a major accomplishment. And yet clients are never going to thank you for losing money. And so maybe that's unrealistic expectations on our side. But I think that everybody wants to have their cake and eat it too. I can imagine somebody asking, well, why are your upside capture ratios lower like in the recent years than they were in the early years? And then the follow-up question is, when are you going to re-hedge the rest of my portfolio? Those are at odds with each other. You can't basically, there's a cost to basically re-hedging and constantly. Every time if you were climbing, if every time that you moved up 1 foot, you're going to knock in a piton, well, you're going to be up there for several months before you scale that rock. And there's a trade-off that we've learned over a long time that you have to take some amount of risk, but basically being able to deal with the kind of the fear, that emotional aspect of clients and what they expect in the short term and what have you done for me recently is very challenging. Now, to that, I would say that we are working right now on being able to provide more, maybe not real time, but on a monthly basis, being able to provide something that is along the lines of the target return band here that basically will basically show what our kind of original design kind of set at the beginning of the year was, and then being able to plot on a monthly basis where we are on this chart to show, to be able for you guys to see and for our clients to see how we're progressing up this line, up the gold line, for example, if the market is going up. You'd be able to see whether we're above that line. Hey, you guys are doing better than expectations. You're outperforming your theoretical design parameter. And then basically intra-year, if we've made money, good income, if we've re-hedged the portfolio at some point, then we'll be able to put on a new line that represents looking at, well, where do we stand right now? And our hope is that by providing that kind of information, you'd be able to see, like on this chart, where is that bucket? You could see it's 8% for the year, but if we re-hedge part of the portfolio, maybe now it's at 4%, and so we're hoping that that type of feedback will help you, help us to avoid some of those concerns and to basically set, better expectations, that where is my protection? Where is, how much can I slide down, for example? And I think that's the main thing I think that is our challenge, and that's on us. Humans are going to be humans. You know your clients and what you have to deal with, and we're just trying to provide you guys with better tools to be able to properly set those expectations.
Okay. Keeping this thing on track here, trying to end at 4 o'clock. I'm going to go ahead and open this up, Dale, for audience questions. I got 1 or 2 more here, but I want to give other people the chance. There's one in the back there, David.
So going back to the trust in your brother, I was partners with my brother for a long time, so I understand that a little bit. But how much of your own personal assets are in this strategy from an investment perspective as a percentage? And then what other types of vehicles, if any, do you invest in outside of your own strategy? Or is 100% of all your invested dollars your own?
Is that to me or Randy? I mean, well, I think that we believe in our strategy, and I know from my 100% of my kind of investable assets, I mean, other than my house and things like that, are invested in the strategy. I haven't found a better way. If I want to go out and gamble with a little money because maybe I'm going to get 100% return on something like that, that's kind of fun, but how much would you do with your portfolio? I mean, that's minor. So, I see no reason to look at other strategies. Although we as a firm, as we have continued to grow, we do vet, for certain aspects of our business, opportunities in the kind of private equity space, and Randy can go into that a little bit more. And so those are some opportunities that we basically provide alongside our strategy for our high net worth clients that I'm definitely investing alongside our clients in those areas.
For me, it's been pretty simple. Historically, it's been 100% of my net worth. In the last couple of years, as part of the program that we're adding, the solutions program, we're building some models and we're adding extra kind of non-public type stuff like private equity and stuff like that. I kind of go back to the chart that Micah put up earlier, the core and satellite. My long-term vision is probably 80% multi-asset DRS and 20%, other type of alt strategies, private equity, venture capital, and stuff like that. It kind of goes back to the whole construction of the portfolio. To me, is when you can put some guardrails on your downside exposure, you really are allowed to get out of the whole fixed income game, which I don't have any fixed income in my portfolio, and I probably won't for the foreseeable future. It really allows us to scale up and add a lot more equities to the portfolio. So from my perspective, it's a simpler approach to say, hey, I can take, let's say, the 4 equity markets around the world and something like GLD, apply that on the apply the DRS to those asset classes, and then I've got a core portfolio that I think is diversified, of course, but also more importantly, it's got the downside protection in place with the limit of risk that we do. On an annual basis to somewhere in the high single digits is kind of what we're looking at. And then as we build out the solutions program, as we get other partners and we do other type of non-public type stuff.
Randy, it's obvious you've had a lot of on-the-job training over the years. During these years, have you had many inspirations or teachers or anybody that's really kind of you've learned from, or you pretty much just worked on it yourself?
Well, actually, it's kind of a funny story. When I went to school, I got a undergraduate master's in accounting and tax. So I always laugh and said I had 3 hours of finance and 35 hours of tax law. Now, that's helped me definitely a lot in my career and stuff like that. But when I got into the investments as a young kid, just reading a lot of books and stuff like that, when I got into options, which was really probably my last couple of years in college and graduate school, options were not that prevalent at that point, and really you only had to buy 5 books. There's probably only 5 books at that point in time to buy. So of course, I bought those books, I read it. Of course, nothing really replaces actual experience, and so really that 5 or 6 years leading up to the launch of the DRS was really kind of my learning experience to kind of try different things and kind of develop my investment philosophy. I'm a big believer in developing an investment philosophy around your personality and your skill set, not trying to be something else that you're not. And so from my perspective, kind of managing risk and structuring outcomes to me is really where I feel most comfortable in the long term in designing the products that we have for the DRS.
So why do you set the hedge in December versus, say, April or May?
Well, the main reason is client expectations. It's easier to talk to people and say, look, if you think about it, we're going to come into the market every year. We're going to set the hedge, roughly around the end of the year. It's not necessarily December, but our experience is it's been, November, December, January, in that time frame. And it puts people on a better expectation, going back to this target return band, and say, look, 1 year out, that gold line is where this portfolio is going to look like over across the entire spectrum of the price movement.
I guess the reason I asked that because traditionally the market has a big correction in the summertime, so you have that run kind of captured your gain.
Well, I mean, that's a good point. I don't know if that would have provided value or not. I just think from the expectation of the clients to put everything on an annual basis, I like going in and saying, if you think about this, you go back to March of '09 when we rehedged the portfolio, I think it was March 9th or 10th. We've been able to ride up the market through this last 10 years, and every year, for the most part, being able to raise that hedge on an annual basis and pretty much be able to say, look, if you think about it, every bit of gain that we've made since 2009 in our strategy, except for, let's just say, high single digits, is pretty much at this point kind of off the table. And I just think it just makes a lot of sense. It's also true there's more options now, but when I started it, they probably didn't have, they had certain options that are long-term that were probably all December at that point. I think they have a lot more now, but at that point, that was probably part of it.
Just one real quick comment. We haven't really talked about the tax efficiency of the strategy very much. I think Randy, said he's got 35 hours of tax law. He doesn't like to pay taxes, doesn't like to lose money. The strategy allows us to buy and hold on the way up and lock in gains while realizing a potential capital loss with the hedge because it's depreciated, and you're able to lock in gains in that way while taking a capital loss, as opposed to having to sell at some high. Market 2013, fiscal cliff resolution. We have to be at all-time highs. There's no way the market's going up, so I'm going to sell out, try to take gains off table, get hit with taxes. We don't have to do that because we're locking in those gains while simultaneously realizing some loss if the market's gone up in the hedge. That's super tax efficient, and it's allowed us to really build up, as Randy said, those gains in the portfolio without ever having to liquidate them. It's amazing unrealized gains, that are kind of built in and that are kind of off the table, as he said. Off the table from a loss point of view because we just lock in higher and higher levels in the market with the new hedge.
I was just going to add one thing to the question there. So another good reason is the expiration of the options, since we're using 2 years, expiring SPY in December and for SPX in January. So that works a lot better. You can't get a 2-year option in June, for example. The 2 years become available generally later in the year, in the later part of the year. But we've also done some analysis as far as what markets tend to do. You also have kind of countering the studies that are done on sell in May and go away with also the December Santa Claus rally. So you kind of usually, historically, sometimes see some pretty stronger rallies at the tail end of a year as well. So historically, but with those things, it fits, like Randy was saying, from client expectation, and then from as far as the options and the options liquidity there in leaps. But also that kind of comes alongside with the fact that whether the market sells off or doesn't sell off in the summer, or whether it has a rally at the end of the year or doesn't have a rally at the end of the year, having that systematic process in place is what really counts for the client.
We got time for one more, I think.
What's the Q1 performance this year on BRS?
We've got about half of the up market. The mutual fund, we're up about 6.98%, and the market was up, 13.38 or something like that. So it's right around the 50% up capture.
And the growth fund was?
The growth fund was 11.88, so that's about 83% up capture.
So I would also just point out, getting back to, we haven't had a bear market in equities, obviously, for a long time. Our GLD track record is actually probably the best example that we can show of what kind of a full market cycle recently, because you've had a lot of moves up and down, and so that's something I would look at as kind of proof that we think over a full market cycle. I think at the end of the day, everyone would say if you could come up with a cost-effective way to hedge your portfolio, why would you not do that? And I think the only really issue is, is 10-year cycles, is that the new deal? Or are we going to go to the 14th inning baseball analogy? I really don't know, obviously. So it just kind of goes back to, we think that if you hedge over the long haul and you use the strategy we've designed, I think if you get some minimal level of income over that time period, you're going to do at least as good as the market. Our long-term track record says we'll do better, but we'll see after the next bear market how much of that underperformance we've had since the low in 2009 do we make back. I think at the end of last year we determined that about a 50% sell-off would make up about 100% of the underperformance. So you can make all the money in the world, but if you give it all back, that's the problem at the end of the day. It doesn't matter You can see a lot of these strategies that get 20% a year and then crap out at the end of the day. 100% loss is still 100% loss. Doesn't matter where it came from, what levels.
Okay,
I think
great.
we're almost to the end here, huh?
Yeah, I think so.
All right, Randy, Rob, Mark, thank you very much. Appreciate it.
All right, thank you.
180 seconds, that's all I ask, 180 seconds. So I would like to thank all of our speakers who contributed today. We had 3 objectives coming in here. Number 1, we wanted to talk about your business, how to impact it, how to maximize the value. And I think you got a lot of knowledge from not just David Grau, but particularly the panelists that were up, those practitioners talking about how they run their businesses. Second is we want to talk about the real economy that's going on, and we got an insider's perspective from Danielle Booth. I mean, you heard from her what's happening in the Fed and the thought of going to the balance sheet expanding to $10 trillion and the Powell put, it's amazing. But you got some perspective and some things to think about. And then the third thing, we want to talk about risk. And there's a number of risks at the portfolio level and what you've got to think about. And we had a great panel, and Jack was up here talking about goals-based investing and then how they address many of these things. So there was a particular scenario that came up recently, but I got a study back in January from Cerulli, and then we saw another one from Northern Trust. And they were surveying your clients, households, ultra-high net worth and high net worth clients. And they said, what are the primary objectives that you absolutely have to have from your portfolio going forward? And you can imagine the demographic. It's the boomer. It's me and older, right? I'm not that old. Anyway, so it's the boomer. And so what do you think those are? I don't have to tell you. You already know the answer. Number 1, I don't want to go through another 08. I don't want to give it back. I don't have time. I can't go back to work. Number 2, I can't outlive my income. I've got to be able to sustain it. Now, hypothetically, this is questions for you. You've got a $2 million relationship. They've been with you for 11, 12 years. They've been through the rough spots in the road. You've held their hand. You wiped the tears. You've watched their grandchildren grow up. I mean, all of that. They got $2 million. They're writing you a check for $20,000 a year to help pay the revenue, the fees. You do a lot of work for it. You do a lot. But think about those 2 objectives. Protect my capital and make sure that I don't outlive it. That's what that $20,000 a year is for, at least in their eyes. If you can't solve for both of those, then you've failed. If we go through another environment, and who knows when it's going to happen, the market's down 35, took 10 months to get there. It'll take you 3.3 years to come out of it, at least that's what the stats say. But if the market's down 35 and your traditional 60-40 portfolio is down 26, you got a 10% allocation to alts, 30% to bonds, that's about where you're going to be. If you're down 26, the question is this: are they going to write that check for 20 grand next year? So the question for you is your business at risk? I think we all know the answer to that question. So our job is to do this. We're an overlay manager. You've probably seen us through the eyes of maybe through a ticker symbol in a mutual fund. We manage multiple asset classes. We manage multiple structures, funds, SMAs, and we do some custom work that you just heard about. So I guess that if you've got income needs, if you need an income surrogate, if you need a way to protect those core holdings, if you've got concentrated positions with big cap gains and you just don't want to give it back, you don't want to sell, I mean, we can do that kind of work. Chris showed you this pretty complex schematic up there of the different things that we can do. So I would encourage you to reach out to your regional director or anybody here with a white badge on if you want to talk about that. So from that, and then lastly, I want to say a thank you to each of you. You took time out of your practice, out of your business. We tried to give you a good full day and a lot to take back. And much like David Shepard said, we do want to become your strategic partner. And with that, we're going to be launching in the back half of this year our solutions. You keep hearing that word come up today. We haven't really talked about what it is, but I will tell you it have 3 components. The models that Michael went through and the complexity that we can take and the customization. Number 2, there's a technology component. We talked about goals-based investing, and I think Terrence back there was, anyway, there's things we can do as it relates to planning and helping with that, but from a technology, and then from a marketing aspect. So you'll hear more from us on that as we move forward. And so with that, I think my 180 seconds are up, and I'm probably between you and that cocktail reception right down there. So again, thank you very much for your day in Chicago.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.